We have just experienced what could be the very first stage of a long-term stock market collapse, with volatility spiking after the market wobbled a couple of weeks ago due to a yen carry trade. The S&P 500 had fallen 8.5% from its peak in July, while the Nasdaq 100 fell over 13.5% from its peak. However, just 2 weeks later, both indexes have pretty much fully recovered. While some people believe that this recent fall was just a blip and that we are now on the way back up to new all-time highs, the data absolutely does not suggest this. JP Morgan even said that the carry trade unravelling is only half complete, with their global FX strategy co-head saying, "We aren't done by any stretch." And there are now a number of high-profile investors and institutions who believe that this rise signifies a clear bull trap and are warning of a chaotic unwind across global financial markets. There are a lot of red flags in the stock market right now, and many major indicators of stock market health are flashing red and indicating a crash or at least a significant correction is coming soon. The S&P 500 forward PE ratio is currently sitting at just under 21, which is a lot higher than the average that we have seen over the last few decades, and is also close to the highs that we saw in 2021 before the stock market saw a big correction, especially in the tech sector. And today, the tech sector specifically is driving a lot of this heightened forward PE ratio, as when we specifically look at the IT sector, we can see it is at highs of 28. This divergence that we are now seeing between the forward PE ratio of the IT sector pulling ahead of the forward PE ratio of the overall market is something that we have only started to see in recent years, and is starting to mirror what we saw take place in the late 90s in the run-up to the dot-com bubble. As we can see on this chart, tech forward PE ratios pulled significantly ahead of the broad market, and it took many years after the peak to see this neutralise. And this chart shows clearly that these bloated forward PE ratios in the tech sector are mostly being driven by the 8 megacap stocks, seeing forward PE ratios in the 27 range. The US stock market cap to US GDP ratio, now famously coined the Buffett indicator, is showing that the market is extremely overvalued right now at about 190%, very close to all-time highs that we have seen in the past, and even exceeds the peaks that we did see in 2000 and in 2007. Buffett famously said back in 2001 that the indicator is probably the best single measure of where valuations stand at any given moment, and that if the ratio approaches 200%, as it did in 1999 and part of 2000, you are playing with fire. With US stock market capitalization getting close to being double the size of US GDP, many investors like Buffett do believe that this valuation is simply too steep to justify holding stocks. And Warren Buffett does seem to be putting his money where his mouth is, and he has started selling stocks at a rapid pace at Berkshire Hathaway. As per their Q2 filing, Berkshire Hathaway did just sell 389 million shares in Apple, reducing their total position by almost 50%, taking the number of shares held from 789 million to now 400 million. Buffett has now sold a whopping 510 million shares in Apple in 2024, which is a 56% reduction in the position. However, Apple does still remain Berkshire's largest stock holding at $84.2 billion. The filing also disclosed $4 billion in Bank of America stock sales, Berkshire's second largest holding, also contributing to a total of $90 billion in stock sales from Berkshire Hathaway for the first half of 2024. These significant stock sales increases Berkshire's war chest of cash even higher from the previous record of $189 billion set in Q1 of 2024 to now being at $278 billion today. Berkshire Hathaway's surging cash pile is an ominous sign of where Buffett believes the stock market could be heading in the future. But Warren Buffett is not the only one selling right now, as we are seeing significant insider selling take place from a number of CEOs and directors. Nvidia stock has surged to astronomical highs over the last 12 months or so, now the third most valuable company in the world at approximately a $3 trillion valuation, and has massively contributed to the major indexes rising recently. Their CEO, however, Jensen Huang, may not believe the company is worth what investors value it at, and dumped a record $323 million worth of his stock in July, just before the market did start falling. This brings his total stock sales to around $580 million this summer, which is by far the most significant selling spree that we have seen him go on. We've also seen Mark Zuckerberg start selling Meta stock again, and also Google CEO Sundar Pichai also continues to make large sales of Google stock. It is very interesting looking at the history of stock sales from both of these CEOs, as both went on large selling sprees back in 2020 and also in 2021 when the stock market was surging, and also just before the stock market saw a quite significant correction throughout 2022. And after this correction, both did stop selling while the market surged again in 2023, but both have now resumed selling again recently, which started towards the end of 2023 but is continuing in recent months. Both CEOs timed the market very well back in 2021, so the timing here is worth noting, and the fact that they are continuing to make sales does suggest that they see now as a good time to cash in some of their stock. There is now a lot of weak economic data coming in as well, and a number of prominent recession indicators are flashing red, which is likely to only push us further to a widespread sell-off. JP Morgan did just boost their US recession odds to 35% by the end of this year, up from 25% last month, while their odds of a recession by the second half of 2025 remains at 45%. And Goldman Sachs has also raised their odds of a US recession occurring in the coming months from 15% to 25%, citing last month's jump in unemployment data. Banks are always on the more optimistic side when it comes to the health of the economy, and the fact that these major banks are rapidly increasing their odds of a US recession starting as soon as in the next few months is definitely a concern. This unemployment data that is cited by Goldman Sachs is one of the more concerning bits of macro data, as the unemployment rate unexpectedly did spike to 4.3%, up from 3.4% last year. A rising unemployment rate is one of the biggest red flags for the US economy right now, because rising unemployment almost always correlates with a period of recession looking at historic data. Now, this is only likely to keep rising considering many large consumer discretionary and consumer staple companies did report weak earnings in recent weeks, which could lead to additional staff layoffs. And a number of these companies also voiced concerns about consumer weakness, saying that many consumers are struggling to afford discretionary items, with some even struggling to pay for the essentials. Now, this does also align with the Consumer Confidence Survey breaking new lows in July at the lowest point that it has been at since 2020 during peak pandemic fear. Meanwhile, the personal savings rate does continue to fall and is now close to making new lows, remaining far lower than where it was pre-pandemic, showing just how much consumers are struggling to save any money right now. We are also seeing the yield curve steepen after being inverted since 2022, which is a textbook signal that a recession is imminent if historic data is anything to go by. This is because for all previous recession periods since 1980, we have seen a recession take place once the yield curve inverts and then reverses this inversion and steepens rapidly. With the odds of a recession looking more and more likely by the week, this is all pretty bad news for the stock market, which historically does not perform well at all during recessionary periods. US government debt continues to surge at a record pace, the budget deficit is also widening, and now the government is facing a critical problem that they have never really had to face in the past, which could hamper their ability to help soften the blow during the next recession. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.